Thank you. Stephen Grocott, Managing Director and Chief Executive Officer with Queensland Pacific Metals, and I'm here with Duane Woodbury, Chief Financial Officer of QPM. QPM is developing the Townsville Energy Chemicals Hub project. That's a project just south of Townsville on the far northeast coast of Australia. We will be importing high-grade nickel laterite ore from New Caledonia from our mining partners, processing that through a relatively new process called the direct nickel process, which uses nitric acid leaching and recovery to produce high-purity battery chemicals, primarily nickel and cobalt sulfate, that feed directly into cathode manufacture for lithium-ion batteries, and also some co-products, some high-purity alumina, hematite, and some.
Stephen, thank you very much for the introduction. Nice to meet you. Duane, good to meet you too. What a story! It's a really interesting thing, kind of bringing the ore from New Caledonia and then processing it in Townsville. When I first looked at this, it really struck me that this was a kind of a transformation process, kind of an energy play from it's a technology and an energy mix to get the metal out of the ore, and you've just signed a gas deal, which surprised me. It was kind of quite an opening up the presentation on the Moranbah. It's suddenly turning you into a gas producing company. It's a transformational acquisition for you. I'd love to hear your kind of a quick summary about it and what the strategic rationale for it was.
Yes, so I'll just give some overview and then pass over to Duane, who led the charge with the General Manager of Queensland Pacific Metals Energy on the acquisition of the Morinbah gas project. But essentially, our process, quite simply, is take some ore, take some nitric acid, take some energy, turn that into the high-purity battery chemicals. All nickel laterite processing processes are moderately energy intensive. The high-pressure acid leaching and our project are down near the bottom end of that, but they still require quite a bit of energy. So you need a relatively secure, relatively low-cost energy supply.
Can I?
Yes.
Sorry, just to ask, when you talk about how much of the kind of the operating cost is energy input as a kind of as a rough guide?
Between 1/4 and 1/3 of the energy of the operating cost. So the ore cost and the energy cost are our primary costs. They're probably 1/3 each. So you do need access to quite a bit of gas. For our project, we need about 12 petajoules of gas to run the project. It's mostly thermal energy, so it's for drying ore and raising steam for the heating processes. It's a small electricity user. So you need secure energy supply, relatively low-cost energy supply. The MGP, Moranbah Gas Project acquisition, provides that security, and it provides a relatively low cost. I'll let Duane talk about that more in a moment. But most importantly, that gas supply comes from some of the world's highest grade metallurgical coal mines. They're quite gassy. Currently, those mines flare and vent nearly all of the gas that they have to dispose of for safety reasons. The open cut mines, of course, it just vents naturally. So that gas is a stranded asset. It's not connected to the Australian gas pipeline network. However, there is a gas pipeline that runs from them to Townsville, straight past the eastern boundary of our plant. So we have what is a stranded asset, and therefore it's not subject to the volatility, and currently the volatility is all in the upwards direction, of course. It's not subject to those high price inflations that we've seen around the world in gas prices. So that's an absolute win for us. Coupled with that, like the rest of the world, Australia is reducing its greenhouse gas emissions. A substantial component of that is through flaring and venting of methane from coal mines. And these coal mines are subject to a mandated, legislated annual reduction in their greenhouse gas emissions of 4.9% a year. There's no real way for them to do that, apart from the white knight called QPM Energy, who has acquired the rights to capture and to process that gas and send it to an end user, us being the main end user, but there are other end users that we will service as well. But I'll let Duane give more detail if you want.
We will come to you, Duane, I promise. But just while we're on the kind of the high level stuff, in terms of the gas pipeline, I see in your presentation it's the NQGP, presumably that's the North Queensland Gas Pipeline. That goes from the coalfields up to Townsville. What was that pipeline for, and why is it empty at the moment?
A very good question. It was built to supply gas to the now shut down Queensland Nickel Refinery. That was under various owners, including BHP, who sold it to Clive Palmer. That shut down in 2016. It's a very old, energy-intensive process. It has quite a significant environmental footprint, a huge tailings footprint. That shut down, and that was a big customer for the gas. It was built primarily to supply them with gas. They shut down, no customer. So that gas pipeline has a capacity which is probably 3 times what we require for our project. So there's ample capacity.
So, Stephen, I might just also add that when the Moranbah project was initially constructed, the other customer was a power station called the Townsville Power Station, which was at the time a baseload 240 megawatt power station, which was being fed by the waste gas from the Moranbah field. That is still in operation, and with the acquisition, we will have the rights to dispatch power through the TPS via the gas that we provide. But the underinvestment in the fields that we've acquired and the lack of, incentive for the miners to reduce their gas emissions until now has meant that there hasn't been basically any gas flowing through the pipeline to the power station. That will change dramatically from when we take control of the asset.
How is the Townsville Power Station currently being powered? What's its energy source?
Gas from the Moranbah project is its own energy source, and it's used as a peaking power station between the hours of around 5 p.m. and 11 p.m. at night. And that is how the energy source for that power station is used. And I should also add that North Queensland, where we're located, is a very renewable energy intensive area with solar and wind. But the firming and the peaking areas is what it lacks. And the Townsville Power Station provides that service for the electricity grid in northern Queensland.
So it's a gas-fired power station, Merlin, without a significant gas supply. And our acquisition of the MGP solves that problem.
So you've on your website, you've got there's a kind of a presentation. There's a presentation on the Morinbah gas acquisition, and in it shows that it's currently producing 10 petajoules of gas per annum. Is that it? Okay, so there is gas flowing through that pipeline. It's just a small amount.
And most of that 10 petajoules, about 7 of it, goes to the Incitec Pivot ammonium nitrate plant, and that doesn't flow through that pipeline.
The Duane ammonium nitrate plant was constructed, I think it was 2012, 2013, to supply explosives to the surrounding coal mines at Moranbah, and 7 petajoules of that 10 petajoules goes directly to that plant for the production of ammonium nitrate rather than go to the Townsville Power Station via the pipeline.
The gas fields produce 10. 7 stay very close to that for the ammonium nitrate for the fertilizer industry, and there's a kind of a trickle that comes through the main pipeline towards the Townsville Power Station. So it's a relatively mature gas source. I mean, it talks about there being over 110 wells. There's also the financial aspect of it, that you paid $5 million to purchase the asset, but you received $30 million in terms of $35 million in terms of working capital. So it's a net $30 million kind of cash injection for you as a company. Are you now effectively a gas company with a nickel business tacked on the side? I mean, just in terms of bandwidth for the next couple of months until you bed this down?
Absolutely not. We're primarily a nickel-cobalt refining project business, and the gas is an integrated part of that. It is a small in terms of number of employees, etc., that we are taking on. And so our focus remains on nickel and cobalt refining, and the energy business will be integrated into that over the next 3 to 4 months and then beyond, once we get the fields performing at higher levels.
Is it going to require a bigger team? Is it going to require more capital?
And the beauty of this field, it's very simple. Over $1 billion has been spent on this field over the last 20 years. It has capacity which is twice what we need for the Tech project in terms of harvesting, processing and transportation. It has been run by a very good in-field team, stable team for 10 years plus, and we basically inherit all of those advantages. And we will put in place a fit-for-purpose operating model, which will not only reduce the costs, but take advantage of some opportunities that we can see to increase production at very, very modest capital costs to ensure that the financial performance continues to grow over the next 2 years as the refinery gets constructed.
So Merlin, all of the capital and equipment is sitting there well maintained and relatively idle. So that's all the gas dehydration, gas compression, etc. All of that is there and functioning. And
let's go back to, you mentioned it in your introduction, about the requirement, the legal requirement to capture this flare gas. You've got a phrase in your presentation which I didn't fully understand: safeguard facilities. Could you just talk to me a bit more about that, please?
So the Australian government has had legislation passed which requires large emitters, and large is defined as more than 100,000 tonnes CO2 equivalent emissions per year. So large emitters have to reduce their emissions by 4.9% per year, or render the cash to purchase the certificates to account for that. So it's a mandated, legislated reduction of 4.9% per year in their CO2 equivalent emissions. That legislation is called the safeguard mechanism, and any site which is captured by that is called a safeguard site. So around the Moranbah gas project is Australia's largest concentration of safeguard sites. So not only do we sit with a very large stranded gas asset there, we've got a very large collection of sites which are captured by this legislation and have to find a way to reduce their emissions. So the gas comes to us, they are no longer flaring it or no longer venting it. That is their reduction mechanism.
And how does that work on an annual basis? I mean, that's a pretty tough ask. I mean, because the compound annual growth is a very powerful mechanism, and 5% per annum reduction, or 4.9% per annum reduction is mind-boggling. In a few years' time, that accumulates. How does that work?
Oh, it's simple that they are forced to reduce their carbon emissions by 4.9% on the renewed base as it goes down. And it is a significant reductions that they're required to do. If not, they can purchase credits for $75 a tonne as an offset where they don't meet their mechanism or the legislative reductions, but that's a very expensive outcome. A much better outcome is to have someone take that gas off lease who can use it for beneficial purposes or for electricity generation, which would meet that 5% safeguard site reduction. Then we have the infrastructure in place now. So if they wish to do that through us, they can actually achieve their objectives for a number of years to come.
But Merlin, you're right. A 4.9% annual reduction across those fields, that's enough to supply our gas.
Yeah, sure. I mean, I get it. It's good for you guys, and it's good and it's good in a sense for the wider kind of energy balance. That all makes sense. It does make me think that in the long run, that they won't be able to maintain a 5% reduction on an annual basis, beyond a few years, because you just can't do that. And really, it seems to me that this is a kind of we might be entering into the realm of the law of unintended consequences, and that there might be financial penalties which will just drive up the cost of things that require metallurgical coal, such as steel or other goods. But that's a whole nother conversation, and about the government law and introducing schemes which seemed like a good idea at the time.
Yeah, it's very similar to the consequences of the European Commission carbon border adjustment mechanism, where there is a mandated reduction in the EU that drives up their costs. However, to make sure that there's not carbon leakage, in other words, energy-intensive industries going to countries which don't have those requirements, there is a border adjustment mechanism. Similar things are being mooted in many of the developed countries around the world. So yes, that will drive up cost for steel production, but that flows through the whole system, regardless of whatever scenario you look at, where we benefit from.
Yeah. Okay. Let's park the problematic government legislation to one side, and let's just focus on the fact that you've got secure, low cost, or kind of steady cost supply. You kind of, in a sense, you control the pricing on that. It's the cost of operations which should be stable. Am I correct?
Correct. That's correct. Yes, it's effectively we'll be delivering cost plus gas or cost gas into Lansdowne Road. So the cost of producing and collecting and transporting that energy.
And are there any mechanisms where you can kind of monetize the spare gas to reduce your cost base?
I think that the main opportunity is we have the right to effectively toll our gas through the Townsville Power Station and generate electricity for sale, which is to our account. So excess gas above and beyond our requirements will be used to generate that electricity, which in peaking times is a very attractive source of revenue for us.
So it's worthwhile pointing out, Merlin, that this acquisition of the Morinbah gas project is supported by three partners: the owners of the North Queensland Gas Pipeline, the Incitec Pivot, Dyno Nobel ammonium nitrate plant, and the Townsville Power Station owners. So we're all in this together because we all see that there's a very large pie and there's much sharing to be done in that value. And part of the value to us is, as Duane explained, the rights to that electricity production. So we increase the gas supply to the starved Townsville Power Station. That means more peaking power generated, and of course peaking power sells at a very nice price.
Thank you. Now let's take all of that and let's have another look at the Nickel-Cobalt Refining plan in terms of when will you be able to refine the capital cost estimates, or perhaps more importantly, the operating cost estimates, in a way that the market can understand it?
So the capital cost estimates are being refined. We're going through value engineering exercises, and we've got independent technical experts appointed by our debt providers going through us with a fine-tooth comb at the moment. That's driving us to do a very, very detailed capital and schedule estimate, et cetera, all the usual stuff, but to a higher degree. So that's progressing well. We aim to complete all that in September, October. In terms of the operating cost, that's pretty clear. That's not really changing. It's about minus 25 cents per pound of nickel because of the co-product credits. So if you take the nickel, you add the credits from the cobalt, high purity alumina, the hematite, and the various rats and mice of other minor byproducts, we end up with a negative OPEX. There's not the real nickel, if they're able to sell outside of Russia, they're substantially negative C1 cost because of their PGM byproducts. we are also negative C1 cost.
Which is quite an extraordinary situation to be in. Coming back to the capital costs, and you're doing the detailed work now, the kind of the fine tuning. But what are the kind of the headline figures, the broad brush previous estimates?
So in November we had an advanced feasibility study where we announced capital costs Australian dollars. 1.9 billion Australian plus 10% contingency. So for about 2.1 billion Australian, that was announced in November. We're going through the value engineering. And important thing, we announced a partnership last week with 3 major German equipment suppliers. They're our main equipment suppliers. It's a company called Plinker, who's a subsidiary of KBR that most listeners would be aware of. Siemens, of course, they're well known. And Andritz, who are one of the world's largest separation equipment and technology companies. So we announced the partnerships with them. They're going through all of their engineering and cost estimation at the moment to refine those estimates down to the level that our debt providers need.
In the last conversation you had with Crux, with Matt, a couple of months ago, you spoke about kind of a project finance split of 50 to 60% project finance, and by implication 40 to 50% through equity. But if you've already got $1.4 billion of commitment in Aussie dollars, with conversations going on with a number of extra banks, so that looks as if it's taking up to the 70-75% mark rather than, or 65 to 75% range rather than the 50 to 60. Is that the right trajectory?
I think bear in mind, on top of the capital plus contingencies, there is the cost of financing, interest costs during construction, and those elements. So the $1.4 billion number was our target for the debt. We're always looking for additional sources to scale banks back, or the old T+1 or T+2. So that's what we're continuing to move down the path of. But that $1.4 billion is a number that we were targeting to reach, and we've got there on a conditional basis with the announcement with Yellow Hermes and KfW.
But of your market capitalisation of 245-ish Aussie, that still leaves quite a step up in terms of the equity component. Let's say it's, 800 or 800 million or a billion. Am I right? Yeah, it'll there's quite a chunk of equity to come.
Yeah, I think the way that you look at this is threefold, Merlin. The first is that we have strategic cornerstone shareholders who will participate in that final raise, and we've disclosed already that General Motors has a commitment of $44 million as part of their offtake agreement at the time of what we call the FID raise. And there's other strategic investors who will most likely come alongside them. The second point is that it is an asset both from a carbon abatement perspective with our energy supply and our nickel-cobalt supply into the EV market, which is of great appeal to some very large institutional investors globally, of which we have been having very detailed discussions and will continue to. So there is demand for opportunities to invest of scale and substance for this area of technology. And the third point is that we have a very loyal shareholder base in Australia, which have been supporting us for a long time and will continue to support us as the capital raising initiatives closer to the time of reaching final investment decision become clear.
When you mention the strategics, are those strategics on your shareholder register? And if they are, could you just remind me of who they are?
Well, our major strategic, our largest shareholders are General Motors with 9.9%, and LG and POSCO with a combined 7.2%. They are our two offtake partners for both stage 1 and stage 2, and our key sort of equity holders at this point in time. There's other opportunities from a strategic perspective that obviously we will be looking at, but that's all part of what the next 6 or 8 months will bring, Merlin. And at this point, we're still sort of formulating how that will all play out.
It's funny, isn't it? One of the harder things to do is to raise a small amount of money. But when you're actually talking about a robust plan with scale and long mine life, actually the big allocations of capital sometimes fall into place with no. I mean, it's always hard work, but it's just as hard to do a small raise as it is to do a big raise.
It's that need to be careful how I express this, because I don't want to be too critical of certain countries and their approach, but the world needs nickel for its electrification, particularly electric vehicles. So the world needs that nickel. Where's it coming from? There's only one place at the moment, that's the China-Indonesia consortium. The capital intensity of our plant, if you look on an apples for apples basis, on a nickel equivalent basis, our capital intensity is less. We have absolutely stellar ESG credentials. If you want to be selling battery grade nickel and cobalt into North America and the European Union, you've got to have a clean supply. So what we've got is tier 1 jurisdiction, stellar ESG credentials, and a low capital intensity by comparison with the HPAL plants when you include their refining capital. So it's all stacked in our favour. It doesn't mean that equity plug is going to be an easy thing to achieve. We have to keep demonstrating to the market and to our strategic partners and to our shareholders and to future investors that this is a project that is not just going to sail, it's going to soar.
Yeah, it's never easy raising money. But my goodness, when you look at HPAL projects, it's high pressure acid leaching. I mean, there's a clue in the name. I mean, these things are corrosive and energy intensive and pretty nasty.
I have worked on a number of them. They are tricky. It can be done right. And most of the failures is because people cut corners. The ones that succeeded did not cut corners, and they're the ones who tend to have some of the higher capital intensities. The Chinese know how to do it right, but obviously they leave out all the ESG capital around effluent treatment and tailings management. But if you add in the effluent treatment and the tailings management costs, the capital intensity of those plants is very high. You can do HPAL, but it is very expensive. Full stop. So that's our competitor.
And looking at the full kind of ESG chain, the where the ore is sourced, what's your responsibility on that? I mean, is there marine disposal of tailings? What's the your responsibility on the provenance of your material?
We share that responsibility with our mining partners, and New Caledonia, of course, is a French territory and is subject to extremely high standards, and they've been doing this for many, many decades. So these are miners who have excellent practices, rehabilitation. They don't have all the problems that you have in Indonesia, where they've got runoff and sediment into freshwater streams and into coastal environments and damaging coral reefs and indigenous populations and so forth. So it's effectively French environmental laws being applied in New Caledonia. They're excellent miners and have been for many, many decades. The other aspects of it, they don't have tailings to manage. Their miners, the ore that we mine it's a very shallow ore, some of it even outcrops. So there's a small amount of overburden to be removed. And then the next part is the limonite ore, the high iron ore that we will process. Beneath that is the saprolite ore, which is the high magnesium ore, which tends to go to nickel pig iron and ferronickel smelters. Currently, that top part of the ore has a limited market, and we're providing that.
And it'll get loaded. Is there any beneficiation or any enrichment or concentration prior to loading and then being shipping to Townsville?
No. It's a shippable ore. So it's good. There's virtually no processing to be done. Some of the HPAL plants, an HPAL plant would have processing to remove the high magnesium rocks that are in there because that consumes their sulfuric acid and they can't regenerate it. We're not so fussy because if we've got some magnesium in there and it consumes our nitric acid, we're regenerating the nitric acid anyway and selling the magnesium byproduct. So it's all a wash for us.
And do you have an understanding of the proportions of limonite ore to saprolite ore that'll be coming your way, or are you agnostic?
No, that's a part of the ore supply specifications that we have with the 3 miners. And they've been doing that for decades. They were selling that ore to the Queensland Nickel Refinery before it shut down, and we're dealing with some of those same miners still. I'm sure you got to spend some time on the Great Barrier Reef while you were there.
I visited the refinery about 20 years ago. It was a good site visit. I didn't actually. I was. I went to Australia and I went 1.5 times round in about 10 days in a small aeroplane. We were just charging round it.
This is one of our hidden advantages. We are not a hardship location. We're just south of a town of 200,000 people, a highly skilled workforce, university, school, and we sit in a tourism mecca on the edge of the Great Barrier Reef. It is not a hardship posting. If we can't find the skilled workforce that we need there, or the construction workforce, you're not sending people out to the desert and a hostile location. It's great for families, and it's great for leisure.
Oh, well, I had a very, very informative and enjoyable trip, although no downtime when I went to Australia. Thank you. It's been a really interesting conversation for me. I've learned a huge amount about the integration of the gas project, about the approach you're taking on the financing. Could you perhaps summarize what the rest of the year is going to look like in terms of kind of what you view as being the value catalyst? Because presumably you think your company is worth more than it is being traded at the moment.
Yeah, I mean, there's very few company MDs or CFOs who would not say the same thing. But the evidence is the growth in the nickel market is stellar. Much of that growth is going to occur to supply North America and the EU, and they require clean nickel and cobalt supply. They are not going to get that out of Indonesia, China, unless they substantially increase their capital spend. So we're a Tier 1 safe jurisdiction that ticks all of the ESG boxes and more. We're a relatively low capital intensity. As we complete our value engineering and more detailed engineering with our equipment supply partners over the next few months, we'll refine that capital estimate. Our independent technical expert working on behalf of the debt providers will complete their review. So, and as we're able to disclose all of this, start to see that we believe that the market will see what the value proposition is of the tech project, combined with outstanding ore supply partners and a gas supply partner who happens to be ourselves now. That's a serious plus. Duane, I don't know if you want to add to that.
No, I think it's that, Merlin. I think you'll see in the next 7 or 8 months till we reach final investment decision, a steady de-risking of the project, and hence an increase in the implicit value of the project and indeed the gas supply chain. I think you can look forward to some very positive stream of announcement over the next 6 months related to our energy supply chain, which will have direct benefits to both the TET project as well as to other supplies we have for that energy. So I think you'll see between the two of them a significant de-risking in the lead up to the FID, which will obviously make the funding a much easier task than where we sit here today.
So Merlin, one of the things that we're best at, should be noted for, is choosing good partners. We've chosen Altilium Group, the technology owners who we have a license from, the best technology for doing this. We've got some of the biggest equipment suppliers, advanced technology suppliers in this game. Sole source supplier relationships with these guys. They are partnering with us and doing engineering work on us. Our financing partners, our export credit agencies from around the world, our engineering partner in Hatch is one of the leading developers of mineral processing plant designs, hydrometallurgical plant designs. Our gas partners, a consortium there of the four of us, counting ourselves. We have great partners, and when you choose good partners and you align the interests, it's a lot easier to kick gold.
Good. Well, gentlemen, thank you very much for the interview today, and good luck with the year ahead.
Thank you, Merlin.
Thank you very much, Merlin.